Hi everyone, and welcome to the Mortgage Message Market Forecast for 2022. My name is Joe LaGiglia, and I am so excited to share with you the information that will empower you and your networks with the knowledge to help you navigate through the year that's ahead of us. So let's get into it. First, I want to start off with where we were a year ago. And in 2021, let's recap what our forecast was. We forecasted that interest rates were expected to rise in the beginning of the year and recover in the fall months. And we did pretty well with this, as interest rates actually did rise sharply through March as anticipated, but they recovered a little bit earlier than we thought. They gained back most of all of their losses by late summer rather than waiting until the fall. And how about housing? The housing forecast was for very strong demand and tight supply, which would push home prices higher. We thought it was a very aggressive forecast 12 months ago to say that we were going to have a high single-digit rise in real estate values. Well, who could have expected the incredible strong demand and tight supply, as well as the disruptions in the supply chain by COVID, as well as labor shortages that pushed real estate values higher than we could have ever expected. But in the beginning of 2021, some prognosticators were actually calling for real estate prices to fall in 2021. So we're happy to be on the right side of that. But depending on the measuring stick you use, real estate values were up somewhere between 11 to 18%. So housing outperformed last year's forecast. Now, in 2022, the Fed is going to play a major role here. We know that they have already decided that they're going to start tapering, and they're going to accelerate that tapering in 2022. That means buying less mortgage-backed securities. They said that they're earmarking 3 to 4 rate hikes this year, and they're going to let their balance sheet run off instead of reinvesting the mortgage bonds that pay off or principal payments that are made, where they buy more mortgage bonds. The Fed's actions can definitely impact the stock market. It can drive interest rates, and it can affect housing and jobs. So the Fed is going to play a major role, and we're going to talk a lot about the Fed in this presentation. So first off, their voting members rotate every other year. There's 19 members, 12 of them vote, and 4 of them rotate in and out each year. So the 2022 composition of the Fed with this rotation should be a little less accommodating, maybe leaning a little more towards tightening than the batch of Fed members that were voting in 2021. Now we know inflation has really gone up quite a bit, the highest inflation numbers that we've seen in 40 years. That is going to be the Fed's main focus. The stock market's reaction is going to be important. The stock market's reaction is going to be important. If it's a negative one to the Fed's rate hikes and them trying to fight inflation, that could cause the Fed to lose their resolve. And we know that this has happened in the past. And the Fed knows that they should have hiked rates sooner. But they mistakenly thought inflation was transitory, and as the saying goes, those who forget the past are condemned to repeat it. So let's take a look at history, because that will help us forecast on how the Fed's actions in 2022 will influence the markets. If we think of what the Fed's going to do and how those actions may have affected the markets in the past, it can give us some clues as to what we may be expecting going forward. So let's go all the way back to the 1970s. And this is a picture of the Fed chair Arthur Burns, who was the Fed chair back then, and he ignored inflation that was increasing rapidly. But he insisted that inflation was transitory. Does that sound familiar? How many times did we hear that word in 2021? Well, year over year, inflation under Arthur Burns ballooned, going from 7% in 1978 to 14% by the time he left in 1980. 14% inflation. But Burns remained steadfast. He said that inflation was transient and mortgage rates responded accordingly. Because remember, bonds, including mortgage bonds, hate inflation because it erodes the fixed return that you get. When you hold a mortgage, the return you get on that mortgage is fixed. So you're buying things with a fixed budget. And if the cost of those items that you're buying are rising rapidly, it makes the value of that fixed return less and less over time. So the only way to combat that on future loans that get done, the money that gets lent out, you have to charge a higher rate. And under Arthur Burns, mortgage rates did what? They went from 12%, which is a much different rate market than we have now. But guess what? They went from 12% to 18%. And when something like that happens, that 12% doesn't look too bad anymore. Can you imagine an 18% interest rate? Now, was this an isolated incident? Well, let's look at more of history. Now, Paul Volcker came in and he wanted to fight inflation. So he hiked the Fed funds rate from 11% to 20%. The Fed funds rate today, as you probably know, is near zero. Again, much different landscapes compared from then to now, but you can imagine going from 11% to 20% in just 2 years. My goodness, we make a big deal out of a 0.25% rate hike now, but hiked in 2 years was 9% on the Fed fund rate. And he was very effective in fighting inflation by taking these drastic measures. Because inflation, remember, under Arthur Burns, got up to 14%. It moved all the way back down to below 5%. And because inflation dropped, mortgage rates sharply declined as well. Remember, they were at 18% and they moved back down to 12. And while today we say 12% isn't a good interest rate, but it was a lot better than 18. But there were consequences. You see, the S&P 500 sharply declined 30%. So there was a 30% loss in stock prices during this time. And this tighter monetary policy, it pushed the United States into a recession in 1982. So 2 years later, our country faced a recession, but Paul Volcker did slay inflation. Now, here's Alan Greenspan. And Alan Greenspan was Fed chair for a long time. In the 1990s, he saw inflation double. It went from 1.75 to 3.5%. So it rose by 1 3/4. And that higher inflation caused mortgage rates to rise because, as mentioned, investors demanded a higher return to combat higher inflation. It went from 7% to 8.5% on a 30-year mortgage. Now, unlike Burns, Greenspan took action in mid-1999 because he saw what happened under Burns. He saw that Burns was wrong, and he wanted to be proactive. So he didn't have to be desperate like we saw under Paul Volcker, when Volcker came in and he had to take desperate measures because Burns screwed it up. Now, Greenspan wanted to be proactive, and he was. He hiked the Fed fund rate by 1.75. That matched the rise you saw in inflation. He took it from 4.75 to 6.5, and he did that in 1 year. Now, inflation responded and dropped by 3.5, all the way down to 1%. So it was very effective again. And guess what? Mortgage rates dropped too. They dropped from 8.5 on a 30-year fix all the way down to 5.5%. And that sparked a huge refinance boom in our country back then. But as always, there were also consequences when Alan Greenspan did this. You see, the S&P fell by 50% from the spring into the fall of 2000. In just 6 months, the S&P lost half of its value. This was really painful. And again, the U.S. entered into recession in 2001. So we have twice that we've had to fight inflation, twice that the stock market didn't like it, and twice that we've entered into recession. Now today, Jerome Powell, our recently re-elected Fed chair, he saw inflation increase in 2021 from about 1.75% all the way to 7%. It got out of hand. And what did Powell say all last year? It's transitory, just like Arthur Burns did in the 1970s. Greenspan seemed to learn, but Powell fell into the same trap as Arthur Burns. Now, the higher inflation caused mortgage rates to rise from very low levels, around 2.5%, upwards to about 3.375, where we are today. And seeing that rise obviously is because inflation was rising. Now, the Fed has just started at the end of 2021 tapering their purchasing of mortgage bonds and treasuries. So they aren't going to do two things at once. They aren't going to hike and reduce purchases at the same time. So they're going to start reducing their purchases and taper first. And then the next thing, when they're done tapering in March, they are going to likely begin hiking rates, which may happen as soon as they are done tapering. Now they're targeting 3 to 4 rate hikes in 2022, and then maybe some more in 2023. Inflation and interest rates can still rise until the Fed acts because inflation should rise through February. So that's going to make it a little hard on the mortgage-backed security markets, especially at the same time that the Fed is tapering. Now, the Fed can be successful if they contain inflation, and mortgage rates, they should really drop, but they may be dropping from higher levels first. Now, let's see if we see a pattern here. So you can see through Burns and Volcker, inflation went up from 7 to 14%. Under Greenspan, inflation went from 1 3/4 to 3.5. Under Powell, it went from 1 3/4 to 7%. Now, what did mortgage rates do? After Volcker took action, mortgage rates went from 12 to 18%. Greenspan, rates went from 7 to 8.5%. And under Powell, they've gone from 2.5 to 3 3/8. And what was the rise in the Fed fund rate? Under Volcker, it went from 11 to 20%. Under Greenspan, it went from 4.75 to 6.5. And right now under Powell, we're looking at going from near zero to close to 1% in 2022. Will we hit 1%? Time will tell. And looking back in history, how did inflation respond? Well, under Volcker, after the Fed fund rate got raised, it went from 14 to 5%. Under Greenspan, it dropped from 3.5 down to 1. And under Powell, these efforts of raising the Fed fund rate should help fight inflation and drop inflation down to lower levels of where it is today. Now, what did mortgage rates do? Under Volcker, mortgage rates went back down to 12%. Under Greenspan, they went from 8.5 back down to 5.5. And under Powell, through these efforts, if the Fed can stay the course, mortgage rates should respond in the same manner by declining once this course has been played out. But what about the consequences? Under Volcker, the S&P dropped 30%, and the country entered into recession thereafter. Under Greenspan, the S&P dropped 50%, and the country entered into a recession thereafter. Right now, under Powell, stocks are a bit expensive, and we do see the economy slowing down. So, could there be a stock market decline with these Fed rate hikes, and could we enter a recession? You have to say that these are really good possibilities to see happen. Now, some of the wild cards are, of course, COVID, which is going to have a major impact on supply chain. So any change in COVID that we don't see on the horizon right now could change this outlook dramatically. And any stimulus that could happen in 2022 could mean more inflation fears. It could push stock prices temporarily higher, and it could cause mortgage rates to rise further. Stimulus would make the Fed's job of corralling inflation so much more difficult. Maybe in the short term we get a boost in the stock market and the economy, but it can make it hard for the Fed to get inflation back in check. And mortgage bonds probably won't like that. Now, the runoff of the Fed's balance sheet that I mentioned earlier is going to be very important because the Fed right now is buying $70 billion a month in mortgage-backed securities. And that's a result of people paying off their mortgage by refinancing their mortgage or even selling their house. Remember, the Fed has several $trillion on their balance sheet of mortgages that they're holding. So the first step is to stop purchasing mortgage bonds and treasuries, which should end in March. The next step is going to be for the Fed to start hiking the Fed's fund rate. And they'll begin likely in March. But the Fed will have to still be buying that $70 billion. And if they stop, well, that could push mortgage rates higher than previously thought. So we have to consider that a wild card. Now, stocks in the meantime are very expensive. This is, by almost any measure, the most expensive stock market that's out there. And because stocks are so high, and with the coming Fed rate hikes, understanding that the stock market historically doesn't like that, it could reduce the price to earnings multiples that are out there. So we could see the stock market contract. Our forecast in 2022, likely 10% decline in stocks, maybe even a little bit more, maybe a little bit less, but we're seeing a 10% drop in stock prices in 2022 because the Fed will be less accommodating. Our interest rate forecast, we think that interest rates will rise along with inflation during the first part of the year. Do they get to the mid threes? Maybe 3.75? We think it's quite possible because we think inflation will continue to heat up to February, and we think that mortgage-backed securities probably won't love that, especially if the Fed is tapering at the same time. But we also think that the softer stock market and slowing economic conditions that should happen later in the year could actually help mortgage rates and should end up pushing them lower, perhaps back down towards 3%, maybe even under 3% towards the end of this year. Now let's talk about housing. Housing will remain really strong in 2022, but not as strong as 2021. Demand is going to be slightly softer due to the rise in interest rates, but still really robust. Supply is going to increase a little bit as supply chains hopefully ease up. Remember, the wild card of COVID, but it's going to remain tight. Labor force, disruptions in the supply chain, and semiconductor shortages will hurt new construction because you need semiconductors with pretty much everything in a home driven by computers, like refrigerators, washer and dryers, dishwasher. They all need computer chips. So this will play a major role. Now, rents are going to be rising as well, and rents have been rising at a dramatic pace, and they will remain above 5% on the increases. So that's going to push a lot of people to see the benefit in buying versus renting. Our forecast is for mid to single high digit appreciation in 2022, so there is a lot of wealth creation available in real estate. This to us looks like while difficult, still a really good time to be a buyer in 2022. I hope you enjoyed this presentation brought to you by Mortgage Message, your trusted source for all things mortgage and real estate related. Please share this information with all your networks, both online and offline. My name is Joe LaGiglia, wishing you a very healthy and safe 2022. Thank you, everyone.